Welcome to The Buy-In. My name is Trent Cripps, Director of Property Strategy at Sevenfold Property Group, and I'm also a long-time avid property investor myself. My co-host, Simon Podger, is Director of Lending for our sister company, Your Future Strategy. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode. Okay, today we're going to be talking about what is a more favourable property type to invest in. Is it houses and units? And this is a debate that's been going on for many a year, and it's really depends on the individual client and their strategy and what they're trying to achieve. And their capacity. I mean, obviously, Simon, lending can play a big role in this because not everyone's got the capacity with house prices the way they're going and how rapidly they're going up. Not everyone has the borrowing capacity to invest in a house.
Yeah.
So units for some clients or some people are just a more approachable and acceptable investment category, if you like.
Yeah, and I suppose like the other thing is that sometimes if you want a particular area, you're just forced to only consider units. I'm thinking like in a city or something like that. Like it's very hard to find a freestanding house in Sydney CBD at a reasonable
absolutely.
Level.
Yeah, no, 100%. And look, I mean, obviously we might get into talking about CBD type investments versus regional investments a bit later. But, with units and houses, obviously there's a bit of a difference in price point. Interestingly, in fact, since the COVID pandemic broke out in the early part of 2020, late 2019, early 2020, since then, data that I've been researching to the end of last year, interestingly enough, the gap between houses and unit prices, broadly speaking across Australia, has actually widened to record levels. So historically, houses have always commanded a higher price than units. However, since the pandemic began, the disparity has grown even more significantly, so much so over that 4.5 years period, houses across Australia basically surged over 44% compared to pre-pandemic levels, while units have only seen a modest growth of about 21%. So the gap is widening. And, if we look at a couple of key markets and some glaringly obvious ones. With Sydney, you've got a median house value right now in and around $1.6 million, whereas the median unit value is just touching $800K. So it's almost, literally double. A market like Brisbane is just shy of $1 million, and units are sitting around $580,000. So we are talking a relatively significant gap. And essentially what's driving that is, the old adage of land. Land is really what appreciates and buildings depreciate. So historically in Australia, houses have always outperformed units and townhouses because of the land content associated with that dwelling type. And like you say, within capital city, or the closer you get to a capital city, you don't build more land. Land is a finite resource, and as population grows and we fill in those land zones, you either move further out or you've got to go up, and up means units, and that means density because historically Australians do want to live near a capital city. So interestingly, with land, it's probably in the 20 odd years that I've been involved in property, it's certainly probably as scarce as it's ever been. So, we're talking, the sprawl in Sydney is now out 60 plus kilometres out into the where you can buy land is 60 plus kilometres to the southwest of Sydney, which is just crazy. I mean, it's 60 kilometres is a long way from a CBD if you've got to commute for work.
Yeah, and I think that's when you're talking about the first time buyers, and it always comes up about the supply and demand, and there's always stuff on the demand side, new policies that come out and things like that, but the prod supply side seems to never get mentioned about land releases or proposals to get them through, and in council changes and things like that.
Yeah, absolutely. I mean, we're unfortunately we're not seeing a lot of greenfield sites coming out of the ground because they're either not stacking up for a developer to be viable, or we also have other issues like some environmental issues that are preventing the land from being developed. Not to mention, whether or not the government infrastructure is there to support that sprawl. So it is a tough one, particularly for first home buyers, because all the incentives around first home buyers has always been with building grants, and that's to stimulate the construction industry. But if the only place you can build is 60 kilometres from a CBD, and I also feel that the government hasn't really kept up with moving with the property values. They haven't expanded the grants to a point.
Caps.
They're saying, the caps are holding people back, and unfortunately, our younger generations don't want to live 60 plus kilometres from the city. They want to be close to where the action is. That's where their jobs are. That's where their friends are. That's where their social life is. So it's got to be a real sacrifice for them to be prepared to build out in these outer region areas of the CBD. So it's a challenging and an ongoing challenging situation that we've got, but essentially, we are going to become, whether we like it or not, we're going to become more and more like some of the cities in Asia, where the only way is up, because we just, with a growing population the way it's growing, density is probably going to be our only real viable option.
Yeah. And I mean, you mentioned the gap between, housing units. And you could see, like, if there was a sort of government policy was to change, for example, and I'm thinking about, older clients, retirees, how do I put it? There was more favourable options for downsizing, for example, when they get those sale proceeds to be able to put into super. And I know they've got some policies there now, but maybe if they were to, expand those, then you could see maybe, apartments actually being, more popular. And may possibly increasing, like wanting the smaller garden because they're not able to look after it and things like that, or as they're closer to family and friends, closer to the CBD or something like that. So it's an interesting one.
Yeah, look, and it's a real, I guess, a shift in mindset changes, because, look, I'm probably showing my age now, but when I grew up. I grew up on the traditional, but back in the, dare I say it, the 70s, grew up on the traditional 800 odd square metre block in Sydney. Those days are long gone because, generally speaking, pretty much all across the country in close to capital cities, we are cutting land up smaller and smaller. So, we're looking at, and not just Sydney, we're looking at what I would consider secondary capital city markets. Places like Perth and Brisbane, that the average land size is now you're doing okay if you get a 450 square metre block of land to build on. So it's changing. So you either got to settle for that smaller block of land to get your own. Your own land, or you've got to jump into the unit and move with the times. But, It's interesting because we've gone through this phase of, Australians wanting bigger homes. I mean, in the Western world, Australians have got some of the biggest homes we build.
Yeah.
Interestingly, and statistically, even bigger than, broadly speaking, or generally speaking, even bigger than US homes.
Yeah.
We want the media rooms, we want the study, we want the additional bedrooms for when, your relatives come once a year. These are some of the luxuries that probably are going to have to be reconsidered moving forward because, when we're talking like a Sydney with a $1.6 million median house value, some compromises have got to be made unless your income can support the borrowing or the affordability of that. So
yeah.
But it's for the time being. I mean, obviously, for an investor, when I talk those capital growth numbers that have happened over that sort of 4.5 year period, it's still very appealing to an investor to invest in a house, in a freestanding house, because of that land content. Because again, strong capital growth comes from land because it appreciates faster than buildings. So interesting times. And the other danger with units that I'm always cautious of when I'm advising clients is we've got to be really careful of some oversupply. We've seen some markets like Melbourne have a unit oversupply, and that really stunts growth. And it has a knock-on effect. It becomes a lot easier for tenants to have freedom of choice, and so therefore you could have a vacancy because there's an oversupply. So there's a number of things to consider, but in saying that, there's always anomalies. If we are talking units, I always think a good sub-segment in the unit space is to have an investment more so in an older style apartment complex that's a walk up, than as opposed to a large scale development that's got 150 plus units in it.
Yeah.
Unfortunately, you're just a box in the air that's the same as the other 140 odd.
Yeah. And I suppose from a lending point of view, lenders can actually target buildings specifically, and reduce the LVR, even blacklist them completely if they've got issues there, or it just adds another complexity to your investment journey as well. So another thing to consider. And I was going to say,
100%.
You've been very negative on units, but surely there are some opportunities there. And as I was saying originally, if you've got your borrowing capacity is just not there, then you're not just going to sit on the sidelines if this is something you want to do. So it's good to see that there are opportunities outside of just a freestanding house.
No, absolutely. And look, honestly, I don't mean to sound negative, but there's always opportunity in any market with any property type. It's just about refining your strategy and looking for the right opportunities. For me, if I'm advising or hunting for a unit, it would be within a complex that's got something different about it. That's not a cookie cutter me too, like some of the larger developers tend to stick to the same design. It's in some good areas close to infrastructure, whether that's train station or hospital or schools or the like. As I said, I really like the more your walk-up style rather than, once you get into lifts, once you get into gyms and pools and tennis courts, you can tend to have things like special levies come up. You can have higher,
the general maintenance costs and insurance
costs.
Your
body corporate fees. Yeah. Yes, your body corporate fees and so forth. So, albeit at face value, units tend to look appealing because they've got a high yield. When you take into consideration things like body corporate and the like, when you actually do the deep dive, it's not necessarily that much more of a yielding option than a freestanding house. But Again, another thing to look for would be ideally something closer to water, something with difference, something that has got a bit of a spin on it. Because if you're just in a larger CBD where there's hundreds of thousands of units, how do you cut through? How do you get that growth? How do you get that tenant? How do you separate yourself? So,
well, it's funny with how you mentioned about the older style walk-ups, to hopefully then get lower body corporate because there's no lift and things like that, and less, gyms and all that sort of guff, which sort of add to both the maintenance and insurance costs and things. But it's also with, those couple of unit developments you've had where they've had those massive building problems, of late. So if you've got a newer unit complex, there's a bit of an unknown if something's going to happen in a couple of years' time. And I'm talking about those major ones where, the ones where they have to close over Christmas Eve and things like that and evacuate the building and things, which is just, I don't even know what I'd do if I was in that situation. When your investment pretty much crumbles, literally crumbles, and what you do. So, as you said, the older ones might be a much better, safer option anyway, and then also be in a better area. You avoid the lift because it's a smaller sort of building. The sizes are probably a bit bigger as well. So there's a few pluses there on those fronts.
Yeah, that's right. And look, particularly over COVID as well, it didn't go unnoticed with a lot of people that, your larger developers, particularly in that unit space, but also in some commercial, that found themselves in a bit of trouble and went into liquidation. So if you're buying a unit off the plan, that can be very dangerous. So, like you said, with the older walk-up style, then there's a little bit more certainty with that. And that's what I like. I don't like taking risk with these. And what I also like about it is, like to what you said, some of these new constructions of units, the quality is not quite there with some of them. And you know what you're getting with an older style unit. They've got good bones in them. And what I really like about that as a viable opportunity for an investor is the ability to actually add value to that property. So whether that's a cosmetic renovation or whether it's putting in a new kitchen or putting in a new bathroom, you can make some serious gains on that if you do that well. And so that's what I like about that. Whereas if you're buying off the plan, you're basically buying it as is. There's not that ability to manufacture any growth.
Yeah.
You're really reliant on, well, is the market going to grow or is it not? So whereas with the older style, if you're in a bit of a downward part of the cycle, you've still got that ability to manufacture some growth through a cosmetic or a bit more of a reno. So
yeah, definitely. I mean, and I'm just thinking from lending and also from the market, but then there's that massive differentiation between your renovated older unit and say level one that's been original condition since day one and never done anything, and so like when the valuer comes out, they can highlight that if that's been a sale that, well, that one can be discounted because it's far inferior than this one. And this is why, even though it's in the same complex, which doesn't add any issues when you get your finance sort of thing, or helps to anyway. And as you said, like when you're buying new, they're all the same, all the same standard. You're not going to pull out a brand new kitchen just to change it up. It's just a waste of money.
Yeah, no, that's exactly right. And as I said, you hit the nail on the head. I think that is the point of difference, and I think that's a key ingredient for successfully investing in a unit. I've got a question for you, Simon. With units, I know lenders take a different view on, say, a studio apartment versus a 2-bedroom or a 3-bedroom unit. There are some restrictions around lending. Can you share with us what your thoughts are on that?
So the usual rule of thumb is looking for anything less than 50. You're going to have very select lenders that are 50 square meters of living area, we should say. So that excludes like the balcony, the car park, literally, close the doors sort of stuff. That's your internals. So anything less than 50, you're really limiting your pool of lenders that you've got available. And so you've just got to be wary of that, because when you're thinking about the growth and the being able to get out and sell it, once you've made a bit of money in it, that buyer is potentially going to have the same sort of problem unless they're a cash buyer. So your pool of sort of potential buyers is also impacted by that inability to raise finance as well. So it's something to sort of keep in mind when you're looking at these things. And also, like, you might see, especially in the holiday spots, the dual key apartments and things like that as well. So that adds another complexity that not all lenders particularly like it. And the sort of the thought process from the lender's point of view is that particular style of property is like a small, bed sitter unit with a small living area or a dual key. It doesn't appeal to the wider open market. And so if they're having to enforce their mortgage and sell that property, being able to get a quick sale to get their money back, their loan, and pay the loan back is hampered. And that's not what they want. They're just in the interest of making their money via interest, not by selling properties or anything like that. So, and that's why there's a sort of restriction on those sort of types of properties with lending and stuff like that. So,
yeah, look, it's really interesting, and this is why we like to have this discussion, because a lot of people think that they can get an easy loan option on any property. But the lenders do have some restrictions around certain types of properties.
Yeah.
I'll just go off a little bit left field for a second while we're on the subject of units, because something that has clearly grown in popularity over the last 5 odd years has been, the Airbnb type investment. It's one, again, that, you've got to have a good strategy around that. You've got to be in the right location. It's got to be a well-considered plan. Not every unit becomes a raging success in the Airbnb market. But again, how do the lenders treat somebody with that strategy against borrowing against a unit that is the plan?
Yeah, well, I mean, assuming it's just let's say a standard unit, so let's say like a 2 or 3 bedroom, nothing, obscure like I was saying before about the less than 50 or anything. It's quite similar to, which I was actually going to ask you on as well, is like the holiday let, So the income they'll look at is, for the whole time, so either 6 to 12 months to try and take out that seasonality, volatility out there, of the Christmas period, the holiday periods and stuff like that, so they can see a full snapshot. And they'll be also pretty much looking at the net income as well. So, yes, you'll get a lot in there, but then obviously everyone takes their clips, through there, the management fees, the Airbnb fees and all that sort of guff, to then sort of work out, right, okay, well, what is the end, rental income before, your interest costs and all that sort of stuff. What do you actually get at the end of the day, sort of thing, net, and that's how sort of they'll look at it.
Yeah, look, it's a really interesting space. I've had this conversation with many people over the years, and again, it's not for everybody.
No.
Again, it comes down to location and the type of property and who's your target market. Where do you think that is going to come from? Because some really interesting things have happened over the last 5 years. So if you, hypothetically, if you had a really good sort of Airbnb unit on the Gold Coast, or dare I say even Tasmania during the early years of COVID, you probably did pretty well because no one was going overseas. And everyone was trying to get out of the CBD. Everyone was trying to have a break. We had some very tough times with extended lockdowns and so forth, and people just wanted to get a mini break. And it was a matter of, could we scramble interstate? And if so, markets like Tasmania went crazy because, it was just an opportunity to get away. And the Gold Coast, the old favourite for most Australians to have at least one holiday every few years is on the Gold Coast. And so that's gone very well. But then the vacuum effect has happened because, once the borders reopen, once we could fly internationally again, your old favourites like Bali came back into it. And, we all know right now the latest thing in the international market is Japan. Every second Australian seems to be going to Japan.
Yeah.
So whilst all that's happening, all of a sudden you've got, less occupancy in the Gold Coast or Tasmania or wherever you might have had your Airbnb unit. So you've got to be prepared and comfortable with the highs and the lows of that because, those types of investments, I don't see a lot of consistency. Obviously, your school holiday periods are very good, but the middle of winter might not be. And, when you look at the holding costs and the running costs of an Airbnb type unit, you've got to be prepared for long-term vacancies because there are just down periods in the market. But
so you've got to have
prepared.
Your cash flow right, to get through those lean periods. You can't just spend it while those summer periods are great sort of thing. You've got to put that aside to make sure you get through those periods. So it's another complexity to, managing your investment.
Yeah, that's right. And people get excited because they look at it and go, well, I'm getting $300 a night. If I permanently let it, I'd only be getting $600 a week.
Yeah.
But not every week you're going to get more than 2 nights to cover what would have been for the permanent let. But the other thing that you've got to take into consideration, again, in that cash flow is Airbnb units. You've got to be fully furnished. So things break, things need replacing, things wear out. I think that type of market is harder on a unit than or on a property than a permanently let one. So you've got to have that contingency plan for wear and tear and replacements and breakages and so forth. But you're also paying a higher level of management fees. You're paying a clip to Airbnb. If you're in a building that's got an on-site manager, you're paying a higher percentage to the on-site manager. So it's really, to your point, it's really about getting that cash flow projections right before you make a decision whether that's a viable investment. But we've gone off on quite a big tangent. Bringing it back, essentially, there's always an opportunity for people, whether it's a house or a unit. It comes back to the strategy. But look, the numbers don't lie. If you have the capacity, if you've got the borrowing capacity and you've got the appetite for it, then, from a capital growth perspective, more often than not, you're going to do better out of a freestanding house. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode.